10 years ago, I made a decision that most of my friends thought was crazy. While they were maxing out their 401ks, flipping houses, and chasing the next hot stock tip, I quietly started buying gold. Not a little gold, not a gold ring or necklace. I mean real gold. Bars, coins, ETFs. A deliberate, consistent strategy that I committed to for an entire decade. They laughed. My brother-in-law called it old man investing. My coworker said, and I quote, "Gold is for doomsday preppers and people who don't understand the stock market." Here's what my portfolio looks like today. And more importantly, here's everything I learned, every mistake I made, and exactly what I would do differently if I were starting over at 35 today. Let me take you back to 2014. I was 35 years old. On paper, life looked decent. I had a stable job in project management, a modest savings account, and I was contributing to my company's retirement plan. I was doing what everyone told me to do: be responsible, save money, trust the market. But something was quietly eating at me. I remember sitting at my kitchen table one Sunday morning, coffee in hand, scrolling through the news. There were headlines about rising inflation, political tension in Eastern Europe, an economist on CNN saying something that stuck with me like a splinter. He said, "The middle class is working harder than ever and losing ground every single year." I thought about my father. He worked for 35 years at a manufacturing company, saved dutifully, retired at 62 with a pension and a savings account, but by the time he was 75, inflation had quietly devoured the purchasing power of everything he saved. The numbers in his account looked the same, but what those numbers could buy had shrunk dramatically. That image, my father, a hard-working man being slowly robbed by a system he never fully understood, that haunted me. So I started asking a different question. Not how do I save more money, but how do I make sure the money I save doesn't lose its value over time? That question led me to gold. Before I spent a single dollar, I spent 3 months just learning. And let me tell you, the gold investment world is filled with noise. There are people trying to sell you overpriced coins, shady dealers, and YouTube gurus promising that gold will hit $10,000 an ounce by next Tuesday. I ignored all of that. Instead, I focused on 3 foundational truths that changed how I thought about money entirely. Truth number 1, gold is not an investment, it's insurance. This was the biggest mindset shift. Stocks grow. Businesses expand. Real estate generates rental income. Gold doesn't do anything. It just sits there. But here's the thing about insurance. You don't buy car insurance hoping to crash your car. You buy it so that if something goes wrong, you're not completely wiped out. Gold is financial insurance. Its job isn't to make you rich overnight. Its job is to make sure that when everything else is on fire, and trust me, in 10 years there will be moments when everything feels like it's on fire, you still have something standing. Truth number 2, gold has outlasted every currency in human history. Think about that for a second. The Roman Empire had a currency. The Ottoman Empire had a currency. Weimar Germany had a currency that became so worthless, people literally burned it for heat. Gold has been recognized as valuable for over 5,000 years. Every single fiat currency ever created has either collapsed or been significantly devalued. Every single one. I'm not saying the dollar is going to collapse tomorrow, but as someone building wealth for the next 30 years, I needed to ask, what's the one asset that has survived every empire, every war, every economic crisis in recorded human history? Gold. Truth number 3, the 5 to 15% rule. After reading books like The Gold Standard and studying portfolios of institutional investors, I landed on a simple principle: allocate between 5 and 15% of your total portfolio to gold. Not 50%, not your entire savings, just enough to hedge, protect, and stabilize. I started at 7%, and that number, in hindsight, was exactly right for where I was at 35. Okay, so let me break down exactly what my gold strategy looked like, because this is where most people get lost. I divided my gold allocation into 3 buckets. I call it the gold pyramid.
Bucket 1, the foundation, physical gold, 40% of my gold allocation. I started with physical gold. Specifically, I bought American Gold Eagle coins and a small number of 1-ounce gold bars from a reputable dealer. Why physical? Because there's something psychologically powerful about holding real gold in your hand. It's yours. No broker can freeze it, no bank can confiscate it, no software glitch can make it disappear. I stored it in a home safe and a safety deposit box. Splitting the location reduced my risk. Now, I want to be honest about the downsides. Physical gold has storage costs, it has insurance costs, and when you want to sell, you have to find a buyer, which isn't as instant as clicking a button. But as my foundation, the bedrock of my financial security, it was worth every penny. Bucket 2, the core, gold ETFs, 45% of my gold allocation. For liquidity and ease, I put the bulk of my gold allocation into ETFs, specifically the SPDR Gold Shares, ticker symbol GLD, and iShares Gold Trust, ticker symbol IAU. These are funds that track the price of gold. You buy and sell them like stocks. They're held in your brokerage account, and the fees are incredibly low. IAU, for example, has an expense ratio of just 0.25%. This became my workhorse. Every month, like clockwork, I would automatically invest a set amount into these ETFs, rain or shine, bull market or bear market. I didn't try to time it. I just bought consistently. This strategy, called dollar cost averaging, meant that sometimes I bought gold at a high price and sometimes at a low price, but over time my average cost smoothed out, and I avoided the emotional trap of trying to predict the market. Bucket 3, the accelerator. Gold mining stocks, 15% of my gold allocation. This is the aggressive slice of the pyramid. Gold mining companies like Newmont, Barrick Gold, and Franco-Nevada don't just move with the price of gold, they can amplify it. When gold prices rise 10%, mining stocks can sometimes rise 20%, 30%, or more. But they can also fall harder, so I kept this bucket small. Just 15% of my gold allocation, enough to add some horsepower without taking on too much risk. Over 10 years, this bucket actually delivered my highest returns, but it also gave me my biggest headaches. More on that in a minute. I want to be completely honest with you here, because most YouTube videos only show you the wins. There were multiple moments in this 10-year journey where I seriously questioned everything. Challenge number 1, 2015 to 2018, the dead zone. For almost 3 years after I started investing, gold basically went nowhere. While my friends were watching their stock portfolios surge during one of the longest bull markets in history, I was sitting on flat returns. My brother-in-law, yes, the same guy who mocked me, started sending me screenshots of his portfolio gains. And I won't lie, it stung. But I went back to my why. I wasn't buying gold to beat the S&P 500, I was buying it to protect what I had. I kept investing. Challenge number 2, COVID-19, the wild ride. When the pandemic hit in March 2020, stocks crashed 30% in weeks. I watched my overall portfolio drop, and for a moment, even gold dipped as panicked investors sold everything for cash. But then something remarkable happened. Gold recovered faster than almost anything else. By August 2020, gold hit an all-time high of over $2,000 per ounce. While people around me were still recovering from stock losses, my gold position had become my portfolio's strongest performer. That was the moment I truly understood what gold was for. Challenge number 3, the mining stock nightmare of 2022. Remember that 15% in gold mining stocks I mentioned? In 2022, rising interest rates, supply chain issues, and rising energy costs crushed mining company profit margins. Even though gold prices held relatively steady, several of my mining stocks dropped 35 to 45%. I had made the mistake of concentrating too heavily in a few individual names instead of spreading across an ETF like GDX. Expensive lesson. I restructured that bucket and haven't looked back. The takeaway? Diversify even within your gold allocation. So let's talk numbers, because that's what you're really here for. Over 10 years, from 2014 to 2024, gold as an asset class returned approximately 130 to 140% in total price appreciation. That means if you had put $10,000 into gold in 2014, you'd have roughly $23,000 to $24,000 today. Compare that to inflation, which eroded purchasing power by roughly 30 to 35% over the same period. Gold didn't just keep pace, it outpaced inflation by a significant margin. But here's the number that matters most to me personally. During the three major market crashes in this period, the 2015 to 2016 correction, the COVID crash of 2020, and the bear market of 2022, my gold holdings acted as an anchor. While my stock portfolio swung wildly, my gold allocation stabilized my overall net worth and gave me the confidence to stay invested in stocks instead of panic selling. That behavioral benefit, staying calm when markets are terrifying, is almost impossible to put a dollar figure on. But I can tell you this. The investors who panic sold in March 2020 and missed the recovery lost far more than any management fee or storage cost I ever paid. Gold didn't just protect my money, it protected my mindset. And my portfolio today? That 7% allocation has grown into a meaningful pillar of my financial life, one that I'm confident will hold its value for decades to come, and that I'm now beginning to think about passing on to my children. If I could go back and whisper advice to my 35-year-old self, here's exactly what I'd say. 1. Start earlier and start smaller. Don't wait until you have a large lump sum. Buy 1 ounce, buy $50 worth of an ETF. Just start. Consistency over 10 years beats a perfect strategy that never begins. 2. Ignore the noise. Gold will have its critics, always. Ignore the hot takes, ignore the comparisons to Bitcoin or whatever the next shiny thing is. Stay anchored to your why. 3. Use the gold pyramid. Physical for security, ETFs for liquidity and consistency, mining stocks for a little growth, but keep that bucket small and diversified. 4. Think of gold as a decade-long commitment. If you're checking the gold price every day, you're doing it wrong. Gold is not a day trade, it's a decade decision. 5. Don't go over 15%. Gold has no yield, it pays no dividends. Going all in on gold means missing out on the growth that stocks and real estate can provide. Balance is everything. Now, if you're in your 30s or 40s right now, you have something incredibly valuable. Time. Time to accumulate. Time to ride out the dips. Time to let that quiet, ancient asset do what it has done for 5,000 years, hold value when everything else is uncertain. The world is more uncertain than it's been in decades. Inflation, geopolitical tension, currency questions, these aren't going away. Gold won't make you rich overnight, but 10 years from now, when you look back at your portfolio, you'll be glad you had something that held its ground while everything else was shaking.
That's my 10-year gold story. The wins, the doubts, the lessons, and the results. If this video helped you think differently about how you're protecting your wealth, do me a favor, hit that like button. It genuinely helps this channel grow. And drop a comment below. Are you currently investing in gold, or are you thinking about starting? I read every single comment. I'll see you on the next one.